Talk to me about pension funds and large capital allocators. It seems like they're really screwed, right? They've for years and years and years now applied kind of a 60-40 type portfolio. A lot of it is kind of cover your asset worse. I don't want to have any sort of career risk. So if I just do what everyone else is doing, then I can't get fired. And that has been okay, right? Most of them are hitting somewhere between 5 to 7%. Their actuarial rate of return is usually somewhere 7.5%, 8%, but they're missing the mark. We just saw CalPERS, which is one of the largest pension funds in the country, decided they're going to now start taking on leverage. They're going to start adding more alternative assets. Like, you just start seeing some of this stuff, and I don't think they even think that they're necessarily becoming more conservative or better investors. They're just saying, like, we have no choice. We have to do this, or literally we can't pay people. Like, how do you read that?
First of all, I want to say Max pretty much got kicked off stage in, what was it, 2005 or 6, when he went on stage with one of the heads of CalPERS at the time. It was 2006.
I'm surprised they let you close.
Yeah. It was at the Triple Bottom Line Investing Conference, and it was just announced. It was like in March or April of maybe 2007 or something like that. 2006, and they had just announced that they bought all these CDOs. The headlines, look it up, from Bear Stearns. And Max said, why these things are going to zero. So, and why are you putting this in these your pension funds for these teachers and government workers in California? And they refused to have their, there was a group photo afterward, and they were like, we can't have Max in there. But of course, because Bear Stearns blew up soon after that. Max said it was going to zero. So, yeah. But I think one quick thing is that in terms of the pension stuff, I think that's kind of intergenerational, because no millennials or Zoomers have pensions, right? It's just the boomers, and the boomers are trying to reconcile with reality. And the reality is that they've incurred a huge amount of debt. They blew the legacy that was America. They blew this giant, amazing economy and turned it into trash, exported all our jobs, left a hollow out shell of Rust Belt and 100,000 annual overdose deaths. So they're the ones that created that. And I think, fortunately for Zoomers and millennials, they've got Bitcoin.
Yeah. Yeah. And, the pension funds, they're getting 5 to 7%, but how far out on the risk curve are they going for that? They're going way out on the risk curve. 10-year treasuries are 1.5%. So they're taking on an enormous amount of risk, and they're exposed to an enormous amount of risk, and they're going to lose an enormous amount of money. And that's pretty clear. What's really sad about the whole pension industry and about the savings industry is that the artificial suppression of interest rates, the past 10, 15, 20 years has effectively moved $5 trillion from pension accounts and savings accounts into the pockets of speculators. It's a theft, right? The interest rates should have been allowed to increase long ago. The normalized rates, if you look at different schools of thought and different studies, you come up with around 5% would be a normalized rate, and we kind of fluctuate around 5%. So we've been hovering around zero for years now. Even though you've got all kinds of indications of bubbles forming everywhere that would require a response from the central bank to raise rates, instead they've lowered rates. And they've effectively stolen a lot of money from these pension accounts. They go into the speculators' pockets, and then speculators end up getting more political power. And then they end up influencing Washington to pass laws to make it easier for them to take money out of pension accounts. Mm-hmm. This is something El Salvador is going to have a chance to avoid, because they're now going to be writing securities laws and rewriting securities laws for the first time in El Salvador. And they're going to do so in ways that go to school on the problems in the U.S. and what's happened, and to avoid all that, and built on a Bitcoin standard. So all that kind of influence peddling, market manipulation, and the market. You've watched our show, my show, us. We've been reporting on this not only on the Kaiser report, but going back 18, 19 years. The amount of manipulation by these banks and bankers is ludicrously off the chart. I mean, Jamie Dimon, I'm not going to go on a huge tangent there, but they've paid hundreds of millions of dollars in fines. They were caught rigging precious metals markets. The Bank of England caught rigging LIBOR market. Every single market maker and bank around the world has been caught manipulating markets, stealing money, front-running markets. Congress is even trading on inside information. The level of corruption is extraordinary, and it's all fueled by that ultra cheap money. That's why they don't want to raise rates. You don't think Nancy Pelosi wants higher rates if she's able to stick her sticky little fingers in the pie every day and take some cash out based on insider trading and artificially cheap credit? That's not where it's going to come from. So they're incentivized to commit fraud. If you took fraud out of the U.S. business model, you'd have nothing.